Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. We're on a mission to become Australia's most trusted property podcast. I'm Pete Wargent, and this week I'm joined by the wonderful Amy Lunardi. Amy, welcome.
G'day, Pete.
How are you today? You're sounding you've still got a bit of a cold by the sound of it. That's been dragging on for a while.
Yeah, it's a riveting conversation to discuss, how sick you are and the weather and everything. But I've been sick for a couple of months now, so it's been very exhausting.
Yeah, you've got a holiday coming up, so you must be due to be on the mend soon, hopefully.
Yeah, let's hope. And Pete, not sure about you up there in Queensland, but it has become quite a bit busier for me here in Melbourne with sentiment in the market picking up. And I'm obviously a very small boutique business, but it really does feel a lot busier than it did, even just a month or so ago with new inquiry coming in. So I've got a lot to do at the moment.
Yeah, I think quite a lot of people who were just kicking their heels a little bit and sitting on the sidelines are now they're seeing more positive media headlines, and they're certainly springing into action a little bit more. I don't know that we're getting any more inquiry by volume, but things just happening a bit quicker, I guess. So
yeah. Sometimes people who reached out, 3-4 months ago, or even 6 or 7 months ago, just bubbling back to the surface and saying, "Hey, I'm ready to go now. I'm feeling a lot better about everything."
Amazing what a few media headlines can do, and
absolutely
changing sentiment. So today, Amy and I are going to discuss some of our personal investing mistakes, what we did, what went badly, and the lessons we can take away from those mistakes. Because I guess at the end of the day, you learn more from the mistakes that you make often from the things that actually went well. So overall, things have gone pretty well for us in property, but there's always things you can do better. So lessons to be learned along the way. So let's run through a few lessons together then, shall we, Amy? So why don't you first, as a rundown, why don't you tell us first the good? What have you done well in property?
Yeah, let's focus on the good first, and then we can and then we can go into the negatives. So today we're discussing property investing mistakes and then more general investing mistakes as well. And I know, Pete, you have been an investor for not a very long time, for a while, for much longer than me. I wish I had been investing for as long as you, and that's a mistake that I will actually discuss in a moment.
That would be part of it. So been around for longer.
But to begin with, when I have approached investing, and our portfolio is mostly property. We do have some other investments as well, but very highly focused towards property because that's what I feel comfortable with. That's what I'm an expert with. And what I think I have done well is every time I have purchased a property or an investment property, bar maybe one of them, I've been very clear with what I want. And my strategy has been very clear. My property brief has been very clear. And for that reason, I've purchased quite quickly. And it's not to say that you have to buy a property fast, by all means, it's not a race, but it does demonstrate that once you do have that strategy in place, then in theory, you should be able to get an outcome faster than if you were looking at all different types of things and not really quite sure what you're wanting, and therefore maybe having a bit of self-doubt. It does help that I'm in the property industry and I've seen and constantly see many, many properties. So I've got more context and exposure when I see a good property. But having a really clear strategy for me has always rewarded me.
So clarity is obviously on the plus side of the ledger. What about in terms of things like managing your budget and cash flows and things like that?
Yeah, so and that's probably one of the second things that I think I've done well is always purchasing a property at that point in time in my life which aligned with my cash flows. So having a really good understanding of how much per month I was comfortable in contributing towards that property and factoring into those longer term plans. So what I mean by that is my first 2 properties, they were lower priced properties because at that point in time in my life, I wasn't on a high income. I couldn't contribute much extra. I didn't want it to impact my future plans. So slightly negatively geared. And then over time, as my income has grown, adding more of those stronger growth properties, more negatively geared options. So I think I've done that quite well over time. And lastly, as well, I have renovated 2 properties especially when I look back at this, on really good budgets. So I've set a really tight budget for those renovations, and I was very involved in them and did a lot of work myself and project manage. And for those reasons, managed to renovate on a very tight budget. So those are the 3 key things that I think I've done well. How about you, Pete? What have you done well?
Well, that sounds pretty topical, because at the moment, obviously, the cost of materials is really high. The cost of trades is very high. And being a Brit, there used to be a lot of property TV shows on in the United Kingdom, and they do these. Sarah Beanie was one of the shows, and they'd say, "Oh, we're going to do this and that to a house," and every single time at the end of the episode, they'd be miles over budget. I don't know, they always say, maybe, allow for a 10% contingency, which makes sense. But I think if for a lot of people are doing renovations for the first time, or if they're an amateur developer, you should really allow for quite a significant contingency, because the number of things that just come up that people don't expect, it seems to catch them out all the time. So if you've done that well and stuck to budget, then that's fantastic, because more often than not, I think people end up overrunning, especially at the moment when the cost of everything seems to have gone through the roof in the real estate industry.
100%. Yeah, it was patting my back here for myself, but I'm doing another renovation now, and we're in a much more challenging environment post-COVID with build costs. So it'll be an interesting outcome this time, I think.
Yeah, and I guess it's one of the things that's put the home building industry under pressure. So many properties are built on fixed price contracts, and now, of course, the price of everything shot up, and it's caused a number of insolvencies in the home building sector, which isn't helping. So yes, things I've done well. I think in property, mainly buying in good locations. So areas where I don't have to sell if I don't want to. I think. I think there's different ways to go about property investment, but I think that's probably been the thing I've done best, really, is stick to the sort of proven or tried and tested sorts of areas in the big cities, close to transport hubs, good school zones, that kind of thing. I think from a portfolio point of view, I've over time at least managed to diversify pretty well, so into resi and commercial, and also in different states and different countries. So when I first started out in Australia, I was very focused on Sydney, but over time I've managed to sort of spread the risk around a bit. So I think it gives me a bit more comfort these days, because I'm not overexposed to any one particular market. I think probably if I was to look at it overall, I think the thing I've done best of all is just sticking with it. I've never sold a property. Always think about it, but then I start thinking about the capital gains tax and the transaction costs, and in the end, I've just held on to everything, which over the long term has actually probably been the thing I've done best of all. So I think there's some useful lessons there in terms of sticking to sort of proven investment strategies and locations, and sticking with it for the long run.
Yeah, and that'll give you more flexibility in the future when you do get to the point in time where you say, okay, I've got it. Now I'm going to use those funds for something else, for lifestyle, for retirement, whatever that is. Having them and holding on to them for the longer run will give you that flexibility. So
that's the idea. So that's enough patting on the back, because I guess the subject today is investing mistakes. So always less pleasant to talk about and think about. But let's run through a few of those. You can go first. You can have the pleasure.
Okay. Well, to begin with, if I am reflecting on before I started investing, so before I got into property and before I started any kind of investing, one of my regrets is, and I think a lot of people have this, is just not investing from a younger age, or not saving from a younger age. And I was always of the mindset, especially because I was at uni for so long, that's an issue for future Amy to deal with. And I had this false confidence that, I'm doing a double degree. Of course I'll get a great job. Of course I will earn lots of money in the future and I don't have to worry about it. But that's not a given. And what happened is I ended up working in an industry which wasn't aligned, wasn't anything to do with my degree. And I started off on 40 grand a year and it took a while to work up from there. So if I could reflect back, I wish I had just put a small portion of my income aside, taught myself a little bit about investing. Although 15 years ago, we didn't have podcasts and we didn't have great resources to learn about all of this. So I look back and I think it would have been a lot more challenging. But even things like I was given 2 grand of shares for my 18th birthday. And then I sold those to, while I was overseas and I ran out of money. And if I had just focused on that a little bit more, it would have put me in a better position so that when I did purchase my first investment property, I could have bought something which was maybe a little bit better. And then that would have rewarded me even more in the long term. So I think that is one of my mistakes / regrets in investing.
I think it's a really tough balancing act because especially for those of us who go on to do higher education, there's potentially 3 or 4 years there where you're studying, you're not really bringing in much of an income. And then I was talking to Chris on the podcast last week, and he said, he went overseas. He was only expecting it to be a 1-year overseas trip, but before you know it, those can turn into sabbaticals or gap years, and it's pretty easy to let years slide by without making any progress. And that's really the challenge, is to try and get the snowball rolling as soon as possible while not missing out on those experiences that all young people want to get as well.
Oh, absolutely. Although if I look back at it, if I had put away 10 or 20% of my income at that time, it wouldn't really have affected me. And I think it's more getting into that long-term mindset of that money is non-negotiable, non-spending money, and establishing those better money habits from being younger, not getting into debt, not having to buy that brand new car, or not always just putting everything on my credit card. So instilling those more sustainable habits in the longer run. But yeah, you're right. It is a really tough balance. Pete, what was one of your mistakes in investing?
I think if I went back to the earlier days, I think because I started out investing in the stock market because my career was in as a chartered accountant. Part of what I used to do is auditing listed company accounts, and then later on I used to write listed company accounts. Pretty boring stuff. But I think this is not really a property investing mistake per se. It's more of just a general investing mistake. But I think there's still some good lessons. I think if you went back particularly if you went back before the global financial crisis, there was an awful lot of people using margin loans to invest in the stock market, which is basically using debt to buy shares, which when the market's going up is fantastic because all of your gains are magnified. And there was certainly a general sense of everybody's doing it. So you're kind of stupid not to. And of course, when you get a
social proof, Pete.
Yeah, that's right. So when you get a market downturn, particularly like we did in 2007, then you get the back in those days, you used to get a text message or sometimes an alert saying you need to top up your margin loan account, or you have to sell some shares, and then the whole framework for investing is very difficult because you've got challenging decisions to make. But I think the key lessons here are, well, firstly, be careful with the use of debt. But I think really the main thing here is just because everybody else is doing something doesn't mean it's necessarily a good idea. And quite often it's the opposite.
Oh, absolutely. Incredibly risky situation. And, it's something that you don't see a lot of people doing these days with margin loans and shares.
Yes, interest rates are quite high as well. It's not like when you borrow for a mortgage, you might be borrowing at, in the good times, maybe 3 or 4%. At the moment, it might be 5 or 6. But on a margin loan, you quite often pay more.
Because the risk is so much higher.
Yeah, and since that time, there's been a proliferation of other products like CFDs and other ways to use leverage. There's options and all sorts of ways you can gear up. So obviously, yes, always whenever you're using leverage, you've got to be very careful.
And Pete, if you had a margin call and you couldn't come up with those funds, what's the risk to you as an investor?
Well, basically, the way that margin loans work is you can only gear up to a certain level. So if you're investing in a blue chip share, for example, you might get quite a high LVR. If you're investing in more speculative stocks, you basically couldn't gear against those, certainly back in the day. Bearing in mind, I haven't used a margin loan probably for 14 or 15 years now, but yeah, certainly back in those days, you basically had a choice. You either had to sell your shares or you had to make a top-up payment. And what you very often found is that the gains that you had made in the preceding year could very quickly be wiped out because the leverage that you're using magnifies the returns on the way up, but then it gets
Magnifies
you
the losses
on the way back down. And yeah, I mean, and people were pyramiding margin loans on top of collateral. It was a bit of a powder keg situation. And certainly if you look back at the stats, all of the use of margin loans sort of crescendoed into 2007 and then fell away, and it never recovered actually. So obviously quite a few people learned the same lesson.
Yeah, and in property, you leverage quite highly. Previously, a lot of investors were leveraging 95%, 100%, 105%. These days, LVRs for investors, especially after the APRA regulations tightened, have gone down quite a lot. But in comparison to other investments, still the LVRs, and when we say LVRs, what we mean is loan to value ratios. So the amount that you could borrow as a loan in comparison to the value of that property is a lot higher in investing in property just because the risks are much lower.
Yeah, different. I think it's one of the things that makes property or real estate unique as an asset class is the way in which you can gear into it. There's three different things. Firstly, you can borrow at relatively low interest rates, which you can't in most other asset classes. Secondly, very long loan terms, 25 or 30-year loans. And also, you don't get margin calls in residential property. So if the value of the property falls, well, as long as you're making the mortgage repayments, you don't get those margin calls. You don't get the text message saying top up your account. Of course, though, whenever you're using debt, you need to take a long-term view in property and make sure you use it carefully. Don't borrow more than you can comfortably afford to repay. So definitely some key lessons there. So let's go on to another one. Amy, back over to you.
Yeah, so I'm going to focus here more on an administrative type of mistake that I have made. And this is when it comes to my business and my job and what I do, I am supremely organized. I am on top of everything. My paperwork is completely in order. And for that reason, sometimes my life administration isn't as organized. It's okay. But this mistake that I have made is just not being on top of my paperwork enough with some of my property investments and my property renovations. So for example, we currently have 5 properties. I help my mum manage her 2 investment properties. And for that reason, there's a lot of paperwork coming in and out. You know, there's property management things, there's insurances. And I realized at one point in time that one of our landlord insurance policies had lapsed, and we didn't have landlord insurance for about a year on one of our properties. And I just realized that I had to get into a bit more of a system where every year I was checking everything, filing everything correctly. I had a bit of a spreadsheet going on from there, and then also doing insurance reviews too. So that's one of my tips. If you are thinking about getting into property and getting into investing, just at the very start, create some kind of system where you can keep on top of things and review and monitor. And further to that, I didn't keep all of my records and all of my receipts from the renovations that I have done. So what that means is that in the future, when I go and sell those properties, I'm not going to be able to claim deductions for that. I'm not going to be able to add those things onto my cost base and therefore pay less capital gains tax. So that is something which I regret doing. That was a bit of a mistake and a lesson learned moving forward.
I remember when I was working in my professional career, I remember as I started to build my property portfolio, I had a couple of people say to me, oh, look, I couldn't be doing with all the admin. You know, it's too much hard work. And yet the same people would be working 60, 70 hours a week. And I think the thing to remember with property, yes, you do need to be organized. But if you've got a property manager and you've got your admin, you've got your files set up, it needn't really take you that much time in an average week.
It shouldn't. It shouldn't really, although you can't rely on the property manager to do all of that for you. And in this case, I think a credit card had expired, that policy was coming to, no one got alerted essentially to that. And therefore, you also need to avoid being complacent and just avoiding the, and just assuming that your property manager is going to do everything as well. But yeah, you're right. It shouldn't, in theory, be that much effort if you just set it up all correctly at the start and just have a few processes in place. That's all.
One of the arguments here against property investment is that the assets can end up owning you rather than the other way around. But I think, as you pointed out there, the key to offsetting that is just being well organised. I think if you try to be a bit proactive instead of reactive, then you can see off some of those problems before they arise. I think well organised filing and just keeping an eye on everything is definitely the way to offset that risk, I suppose. So let me cover off another one of my mistakes then, Amy. But I think I'll do one more in the stock market before I come on to the property stuff. I think the other thing that I did wrong in stocks, in fact, not I think, I know, was getting involved in the more speculative end of town. I think to some degree, when you're younger, you can afford to take some risks, and sometimes it's borderline gambling instead of investing. I think because I worked in the mining sector, there was an awful lot of people, the executives, people who worked in the industry, were punting on the penny stocks back at the sort of the lower end of town. Of course, in Australia, when the mining boom peaked, a lot of those valuations went south pretty quickly. I think the lesson here is really to work out, are you actually investing, or are you trading, or actually just punting?
And Pete, can you describe what penny stocks mean, what they are?
Yeah, so I guess it's a phrase that's probably gone out of fashion a little bit, but back in the day, it's really referring to stocks and shares that would trade maybe just for a few cents. So in Australia, we get a lot of companies that are set up to explore for mining assets. So they'll do some drilling in Western Australia or other parts of the country, looking for Lassiter's Reef or the next big deposit. So quite often those companies, they're not really making a profit. They're pretty early on in their journey. The valuations will be very small. And what people are hoping to do by investing in the penny stocks is maybe buy some shares in a company for 5 or 10 cents and hope that one day it goes to $2 if they make a big discovery. So resources is quite a big part of the Australian stock exchange. And I think the lesson here is really, these days it's very easy as an investor if you want to invest in something that you can potentially hold forever, because you can buy an index fund or an ETF that owns a broad basket of stocks. But if you're investing in those types of companies, it's a timing thing. You're just trying to get the timing right, get in and out, make a quick profit. We see this in property as well. Quite often when people are trying to flip property for a quick profit or invest in a regional hotspot like a mining town, that's all about getting the timing right. Whereas I think what I learned really from that episode is, for me anyway, was to try and invest in things that if I don't want to sell, I never have to. So ETFs, index funds, capital city properties that are good locations. And that's really what's worked for me best. So again, a little bit like the first point, it's really a risk management thing, but speculative investments, yes, there might be a place for them with a small part of your portfolio, but for most people, you really want to be a long-term investor in quality assets if you can.
Yeah. Oh gosh, absolutely. And it kind of leads into my next mistake in that one of the strategies which I probably didn't get quite right with my property investing is when it came time to buy our fourth property, we were at the point in time where we thought we could either have this as a pure investment, or we were half thinking maybe this is a property which we could potentially move into at some point down the track. And when I am approaching investing, I am absolutely trying to always recommend either you do one or the other, ideally. And if there's a bit of a crossover and that achieves that purpose for you, that's a bonus, but it shouldn't be the overall goal. But this was something that we were sort of toying around in the background. But the issue is that we were so far away from moving into that property. We were planning for a future that didn't yet exist. And so much can happen over time. And we bought this property back in 2016 thinking maybe by the time we have a family, we'll move into it in 4 or 5 years. But then COVID happened and I started my own business and all of that got pushed out. And it's coming 8 years down the track and we still haven't yet moved into it. And our life has changed so much in the meantime. So on reflection, and it has worked out for us in the end because we are going to move into it, but it has also cost us a lot in the meantime to hold on to that property. Perhaps we could have invested in a pure investment property, which would have performed better over the longer term, given us more flexibility and choice right now. So if you are overlaying the idea of moving into a property at some point in time, just understand that planning for 5+ years ahead can be really, really challenging, and just think about how that could impact your investment decisions and decide if that's worthwhile or not. So, and also ideally, if you can, approach investing as either this is an investment property or this is a home. And then again, if you can make that crossover in any way, that's a bonus, but you need to go into that understanding that there are drawbacks with that strategy.
So a lot can change in 5 years. Life can get in the way sometimes, and that's really a planning point. And that actually segues quite nicely into my next mistake, which was really a due diligence mistake. But we were buying a place, I can't remember the year, I think it was around 2008, in the panic of 2008, 2009. We were buying a place to live in Bondi in Sydney, and we found a place. We really wanted to buy this place, to live in it. It was just a unit, and we got a solicitor to review all the documentation. And then after we bought the property, we got a special levy, and we had to top up the sinking fund. Now, of course, we went back to the solicitor and said, well, hang on, you've reviewed all the documents, didn't give us any pointers here. What's the value in paying a solicitor to read all the documents if they're not going to highlight it? And they said, well, suck it up, basically. So I think the key lessons here are really there's two. I think get a specialist strata report. They cost, depends on where you are in the country, maybe a couple of $100, maybe a bit more. But actually take the time to read it yourself if you can, rather than just relying on somebody else, because in the end, it's you that's going to have to own the property. And if there is an issue that comes up down the track. Now, in this case, I think the levy was a couple of $1,000. It was annoying rather than catastrophic, but it did make me realise, that actually, if there's a really significant issue, you need to be across these things. So that's really a due diligence point when you're buying something that's on a strata scheme, like a unit or a townhouse.
Yeah, and in that situation, so in New South Wales, you can engage people to do, people who are strata searchers, professionals to do all of this for you as well. But of course, you should read the documents yourself. You don't necessarily have legal qualifications, but you can read through some of these things and say, well, what about this? What about this? Here in Victoria, you do receive Owners Corporation minutes and the certificate in the Section 32, but we always also call the Owners Corporation. And if they're not happy to speak to us, because sometimes they aren't, we get our questions answered via the real estate agent, and then we get them to get those questions from the OC in writing. You don't take the real estate agent's word by all means, but that's because sometimes minutes and these strata reports don't capture absolutely everything. So part of the questions that we ask is, are there any special levies which may potentially come up in the future? And sometimes through those conversations, that Owners Corporation manager will say to us, well, yes, there was actually a discussion around painting that entire block a couple of years ago, and that's something that will potentially happen in the future, and it's not guaranteed. So you can approach that purchase knowing that that may be a cost and just not be surprised in the future if that happens. So always doing some extra due diligence, and that segues perfectly, Pete, into my my next mistake as well, which is just being aware that when you engage professionals, of course you are trusting and hoping that they are going to be doing their job properly. But like in your example, Pete, your solicitor who reviewed that contract didn't necessarily do their job properly. And I have had situations in the past as well, which have been similar. And one example is I've had a couple of issues with property managers over the years. I've had some fantastic ones, But because in property manager, there's a bit of turnover, sometimes I've had some not so good ones. And I have had issues where I've had vacancies for longer than I should have because that property manager was not doing enough inspections. They weren't dropping the rent when they should have. They weren't being proactive. And then I'd have to come in at the last moment and essentially fix things. Say, let's do another market analysis. Let's drop the rent. And we got a tenant in straight away. Or other situations where they haven't done paperwork correctly and I've had to come in and fix those things. So just not assuming that other people are always doing their job. And then also relying on professionals when I've done our property development. Oh my gosh, so many lessons learned there where I engaged a lawyer to do a certain thing and I just wasn't hearing from them. I was getting no updates and I ultimately had to step in and take over that role as well. And with council, assuming that council are, they say they'll get something back to you in a certain period of time and they don't. And then me having to proactively fix those things. And now when I'm approaching any kind of working with professionals, I'm always going into it with the mindset of, yes, I'm engaging them. They are professionals, but I'm going to be monitoring this and I'm going to be touching base and thoroughly reading everything and checking things and politely nagging them as well if things aren't happening as quickly as they should be. So just understanding that you need to be approaching all of this, whether you're investing or just buying a property or doing a renovation, you're in the driver's seat and the ultimate responsibility and risk falls on you and approaching it with that mindset. Is that fair enough, Pete?
I think it is. Yeah, you've summarised it perfectly. I've got nothing to add there. Very carefully chosen phrases as well there. So I think I've got two more on my list. I think one of them is kind of a crossover really between the body corporate theme and also what you were talking about before about are you buying an investment or somewhere to live? So when we traded up from Bondi, we wanted to move to a place closer to the city on the harbour. And we bought a unit there, just a 2-bed, 2-bath place with parking. But the place had this place we were moving into had a gym, had a pool, had a concierge. Now we were training to do the marathon at the time, so the idea of having a pool and a gym was fantastic. Anyway, later on, like all of our properties, we've always held on to them, and it became a rental property. But then, of course, if you're going to own a property for the long term and you're paying for a gym and a pool and a concierge, very often people don't use these facilities and they can be pretty expensive on an ongoing basis to pay for. And actually, I think even sometimes a high strata fee can impact the resale value of your property because the next person doesn't necessarily want to pay high quarterly fees. And that could impact or stunt the capital growth. So again, it's not necessarily a catastrophic mistake, but it's sometimes it's an annoying ongoing cost. And I think if you were buying a pure investment property, especially if it was on a body corporate or a strata scheme, you'd probably try and look at something where the fees were pretty modest or reasonable instead of paying for expensive facilities that people don't always use.
That's right. And strata fees can change over time too. And the older a property gets, the more expensive they can become. So just because you're paying, $5,000 or whatever it is today, doesn't mean that will be the case in the future. Depending on the size of the block that you purchase in, that property might have, that owner's corporation or body corporate might have a long-term maintenance plan. So in theory, your money is being put aside every year to save up for things in the future. But properties can deteriorate faster than you expect. Things can break down faster than that maintenance plan suggests. So absolutely.
Or sometimes even with new properties, I think there was a case of a new tower block on Queen Street in Brisbane where the strata fees were set initially, but then after a year or so, the strata fees had to go up because the costs were higher than expected. Sometimes you get these teething problems with new properties and you get some unexpected nasty surprises there. So it's one of the reasons I prefer not to buy brand new if I can avoid it, because who knows what might be coming. So back to you, Amy.
Okay, well, my last mistake is not purchasing properties when I knew it was a good time to buy. And what I mean by that is over the last 10 years, I've been in many markets where it's been a buyer's market. So for whatever reason, prices have come down. There's not a lot happening, but this has usually been caused by some macroeconomic shock, which is impacting everyone. You know, COVID, back in early 2019, late 2018, just before the election, where we were all worried that negative gearing was going to get scrapped. So, and more recently, late last year, when interest rates were high and we didn't know when that end was in sight. And in all of those periods of time, you know, as a buyer's agent, I was seeing properties sell for what I knew was, you know, really good opportunities. And if I look back over the years, just if I had more confidence to jump in at that point of time, it would have been challenging for me, because it wouldn't necessarily have been times when I was actively planning to purchase. So it would have been a little bit more speculative. But if I had done that, then those properties, on reflection, what I see that I could have bought them for and what they're worth now, I wouldn't necessarily have had to keep them forever. I could have then unsold them, or, you know, I'm not talking about flipping, getting in and getting out, but that's just the power of hindsight, isn't it, Pete? We all look back and we see opportunities that we could have taken.
Very few people like to catch a falling knife in property. I think it's easy to say, but actually when it comes down to it, most people, it goes back to the social proof point you were making before. People actually feel more comfortable buying in a booming market because everybody else is doing the same. But actually, I'm sure, looking back on my journey, the best results have usually come from buying when everyone else was panicking. You know, 2008-9 in Sydney was a good time. People were practically giving properties away at times, or desperate to sell at any rate. Also, I think you know, there's some good opportunities if you want to be counter-cyclical, like Geelong in 2014, when everyone was saying, oh, the closure of the car industry, it's the end of Geelong. And if you look at the results over the next decade, they were really good. I think in Brisbane 5 or 6 years ago, you could pick up apartments very, very cheap because it was kind of ground zero for the oversupply of property. But now we're in a shortage, you know.
Absolutely. Again, and looking at Geelong as well, we started investing for our clients in Geelong about at that time, sort of 2015, 2016, and those clients had exceptional growth. And again, that's one of my mistakes looking back then. And I had the confidence to help my clients buy there, but I should have bought there as well. But it does need to fit into your own personal strategy. You shouldn't just go out and buy a property because it's a buyer's market, or just for the sake of it. It does need to fit into your cash flows and your longer term plans. But Pete, just to draw this whole episode back to the very end, you've got one final mistake here, which is to do with tenants.
Yes, I think, again, this is where, you know, be easy to sort of blame a property manager and say, well, you should have and we should have. But yes, we had, most often we try to buy in blue chip areas. So we haven't, you know, overall, we've had brilliant tenants and very few issues. But we had one instance when the rental market was pretty soft, and we got an application where the applicants actually offered more than the asking price for the property, but it was two couples who applied instead of, you know, normally you get an application from a professional couple or a young family, but we had two couples who applied together. Two of them were from overseas, and we didn't have reference checks, but they assured us, you know, it would all be fine. And I think, you know, we were thinking, well, you know, someone wants to pay more than the asking rent, and this has got to be a good thing. In hindsight, not so much. I mean, they had parties, they had the police called out, there was noise complaints, there was smashed glass on the balcony. I think at one stage they were subletting the apartment out to friends on holiday from overseas. It was an absolute disaster from start to finish. And in the end, we actually had to ask them to leave the property. So in every sense, the extra rent wasn't worth it. So again, sometimes these things they're more obvious in hindsight. You know, at the outset, it all sounds very credible. You know, what could possibly go wrong? But yeah, I think it's a due diligence point, really. If you can get reference checks, and you often find, we've had people who rent from the armed forces, for example, or in the Navy, and you usually find people with professional careers are far less likely to be troublesome in that sort of a way anyway.
When I'm helping clients purchase investment properties, we're all doing a very, very thorough analysis to understand what that property is worth. And sometimes I have had investors say, well, let's just try for more. Let's just try for an extra $40, $50 a week, when tenants are quite price sensitive. And sometimes if you do price that property too high, or you have an application come through which is far above market value, it's for a reason. And potentially it's because those applicants haven't been able to get a rental anywhere else and they're having to put more money down for that reason. I'm not saying that's across the board, but I've had a few situations where some of my clients have done that against my advice, and they've ended up having issues like you've had, Pete, or they've had lease breaks because that tenant couldn't actually afford it over time. And yeah, it sounds good in theory, having that a little bit of extra cash flow, but not necessarily always worth that risk.
I needed you on my shoulder, Amy, to tell me that at the time, because it was a lesson learned the hard way. It wasn't a good experience for anybody in the process, not for the property manager. The building manager was tearing his hair out, and it wasn't good for us or the tenants. So, well, I think we've covered off a fair few things there. So some key themes, I guess, careful management of debt, good planning, definitely very thorough due diligence when you buy a property. Same when you're engaging professionals, whether that's solicitors or property managers, choosing your tenants. What else have I missed, Amy? There's a fair few good points in there.
Oh yeah. Well, look, it all really just comes down to you're the driver here of your own journey. You need to take responsibility, and mistakes do happen over time, but the more effort and time you can put into the research at the very beginning, the better. And these days, there's not really an excuse to not do your research, because we have all of these amazing resources. We've got podcasts and we've got online courses and so much information out there. And then, adding in professionals to your sphere to support all of that. But yeah, always just coming back to make sure that you're doing your own thorough research and due diligence first.
That's a very good point. The journey won't be completely smooth. There's always ups and downs, and things can always go wrong. But generally speaking, property can be quite a forgiving asset class over the long run, provided you do the necessary due diligence along the way. So thank you so much, Amy, for joining today. Thanks, everyone, for tuning in. Now, if you do have any questions on anything we've talked about today, or if you want to get in touch, do check out the show notes and feel free to drop us a line. Leave us any feedback, and we're always keen to answer your questions. So thanks, Amy, and thanks everyone again.
Thanks, Pete.